Picture this. You're sitting at your trading desk, staring at two different strategies. One promises you $3 for every dollar you risk. The other only offers $1 for every dollar you put on the line. Which one makes you richer? If you picked the 3-to-1 ratio, you just fell into the same trap that's bankrupted more traders than any market crash ever could. Stay with me, because what I'm about to show you will completely flip everything you thought you knew about making money in the markets. Let me tell you about Marcus. Smart guy, engineering degree, loved numbers and logic. He spent 6 months studying trading, read all the books, watched all the videos. Every single expert told him the same thing. Never take a trade unless your reward is at least 3 times your risk. Made perfect sense to him. Why would anyone risk $100 to make $100 when you could risk $100 to make $300? So Marcus set up his charts, found his setups, and placed his trades with iron discipline. 3 months later, his account was down 40%. Meanwhile, his friend Jessica, who started trading the same week, was up 20% using a 1-to-1 risk-reward ratio. Marcus couldn't understand it. The math didn't make sense. He was doing everything right, following the rules, being disciplined. Jessica seemed to be breaking every rule in the book, and somehow winning. This is the moment most traders quit or blow up their accounts, because they can't see what's really happening beneath the surface. Here's the brutal truth that nobody wants to talk about. Risk-reward ratios mean absolutely nothing without win rate. Nothing. They're just pretty numbers on your screen that make you feel smart and disciplined, while your account bleeds out. The real game, the only game that matters, is something called expectancy. This is the mathematical formula that actually determines whether you make money or go broke, and most traders never even learn it exists. Expectancy is simple. Take your average win, multiply it by your win rate, then subtract your average loss multiplied by your loss rate. That's it. That's the number that decides your financial future. A positive expectancy means you print money over time. A negative expectancy means you're slowly dying no matter how disciplined you think you are. And here's where it gets interesting. A 1-to-1 risk-reward with a 60% win rate crushes a 3-to-1 risk-reward with a 30% win rate every single time. Let's break this down with real numbers so you can see exactly how this works. Imagine you take 100 trades, risking $100 each. With a 1-to-1 ratio and a 60% win rate, you win 60 trades making $100 each. That's $6,000 in wins. You lose 40 trades losing $100 each. That's $4,000 in losses. Your net profit is $2,000. Your expectancy per trade is $20. Not bad, right? Now let's look at the 3-to-1 ratio everyone worships. Same 100 trades, same $100 risk, but now you're targeting $300 wins. Problem is, your win rate drops to 30% because you're trying to squeeze more profit out of each move. You win 30 trades, making $300 each. That's $9,000 in wins. Sounds amazing until you count the losses. You lose 70 trades, losing $100 each. That's $7,000 gone. Your net profit is only $2,000, same as the 1-to-1 ratio, but your expectancy per trade is still $20. Wait a minute, you might be thinking, if they both make the same amount, what's the difference? Here's where reality crashes into theory, like a freight train. Those numbers assume you can actually achieve and maintain those win rates. In the real world, hitting 60% winners with a 1-to-1 ratio is challenging but doable. Hitting 30% winners while targeting 3-to-1 ratios is brutally difficult, and here's why. The market doesn't care about your profit target. Every single tick your trade moves against you after entry, your probability of hitting your target decreases. This isn't opinion. This is mathematics. When you set a profit target 3 times further away than your stop loss, you're demanding that the market move 3 times further in your direction without hitting your stop. The market is random noise wrapped around trends and patterns. The further you ask price to travel, the more opportunities it has to reverse, chop, and shake you out. Think about it like throwing darts. If I put a dartboard 5 feet away and tell you to hit anywhere in the bullseye region, you'll probably land a decent percentage of your throws. Now imagine I move that dartboard to 15 feet away, but make the target 3 times smaller. Sure, if you hit it, you get triple points. But you're going to miss a lot more often. That's exactly what happens when you chase bigger reward ratios. There's another factor that destroys traders chasing high risk-reward ratios: psychological torture. When you're in a trade targeting 3 to 1, you have to watch your position move into profit, maybe get halfway to your target, then reverse and stop you out for a loss. This happens over and over again. You see the profit, you taste it, then it's ripped away. After the 10th time watching a trade hit twice your risk in profit, before reversing to stop you out, your discipline starts cracking. You start moving your stop loss. You start taking profits early. You start second-guessing your strategy. The beautiful 3 to 1 setup that looked so good on your spreadsheet becomes a psychological nightmare that slowly erodes your mental capital. Meanwhile, the trader using 1 to 1 ratios is getting in, getting out, banking profits, and moving to the next trade without the emotional roller coaster. Here's something else nobody tells you. Market conditions change. A strategy that delivers 30% winners this month might only deliver 20% winners next month. If you're running a 3 to 1 ratio and your win rate drops from 30 to 20%, you're now losing money. Your expectancy just went negative. You need 33% win rate just to break even at 3 to 1. Drop below that, and you're bleeding cash while feeling disciplined. But if you're trading 1 to 1 ratios and your win rate drops from 60% to 50%, you're still breaking even. Drop to 45% and you're only losing a little. You have a much bigger margin for error. Your strategy is more robust. It can withstand changes in volatility, changes in market structure, bad days, bad weeks. This is called system resilience, and it's worth more than any perfect backtest. Let's talk about something called the gambler's ruin problem. This is a mathematical concept that explains why even positive expectancy strategies can blow up accounts. The idea is simple. If you have a limited bankroll and you take enough variance, you can go broke before your edge plays out. The higher your risk-reward ratio relative to your win rate, the more variance you introduce into your results. With a 3 to 1 ratio and a 30% win rate, you're going to experience long losing streaks. The math says you could easily lose 10, 15, even 20 trades in a row without it being statistically unusual. Can your account handle a 20-trade losing streak? Can your psychology handle watching your account drop 20% before you finally hit a winner? Most traders can't. They break. They change strategies right before the winners come. They blow up. Compare that to a 1 to 1 ratio with a 60% win rate. Your losing streaks are shorter. Your equity curve is smoother. Your drawdowns are smaller. You sleep better at night. You stick with your strategy longer. You actually give your edge time to play out. This is why the supposedly inferior ratio actually makes more money in practice, because you can actually execute it without destroying yourself. Now let's address the elephant in the room. What about those traders who show screenshot after screenshot of massive wins with 5 to 1, 10 to 1, even 20 to 1 ratios? They exist, and their results are real. But here's what they're not telling you. Their win rates are extremely low. They've survived multiple account blowups before figuring it out. They have massive capital reserves to weather the variance, or they're showing you their best trades while hiding the hundreds of losses. There's a concept in statistics called survivorship bias. We only see the traders who succeeded with extreme strategies. We don't see the thousands who tried the exact same approach and failed. It's like looking at a lottery winner and thinking buying lottery tickets is a good investment strategy. The winner is real, but the strategy is still negative expectancy for 99.9% of people who try it. Here's a secret the profitable traders know. Consistency beats glory every single time. The goal isn't to hit home runs. The goal is to hit singles and doubles all day long until you look up and realize you've scored 50 runs. A 1-to-1 risk-reward ratio with a modest edge executed consistently over thousands of trades will build wealth steadily and reliably. It's boring. It doesn't make for exciting social media posts. But it works. Let me give you another angle on this. Professional poker players understand expectancy better than almost anyone. They know that going all in chasing massive pots feels exciting but isn't optimal strategy. The best players grind out small edges repeatedly. They fold more than they play. They take small pots consistently. Over millions of hands, these tiny edges compound into massive wealth. Trading works exactly the same way. The institutional traders, the guys moving billions of dollars, aren't swinging for 3-to-1 ratios. They're scalping tiny edges thousands of times per day. They're taking profits quickly. They're cutting losses even faster. They understand that in a probabilistic game, the way you make money is by finding small, repeatable edges and executing them with massive volume and perfect consistency. Size and frequency, not ratio. There's also the reality of market efficiency. The easier a profit is to capture, the more traders will compete for it, and the smaller the edge becomes. A 1-to-1 ratio trade might have a robust 60% win rate because you're taking what the market readily gives you. You're not fighting against probability. When you demand 3-to-1, you're essentially betting that the market will do something unusual, something that doesn't happen as often, something that's harder to predict. Think about market structure. Prices move in waves, impulses and corrections, trends and ranges. Most moves are relatively modest compared to the volatility. Occasionally, you get extended runs, but they're the exception. When you target 1-to-1 ratios, you're capturing the normal market behavior. When you target 3-to-1, you need the exceptional moves. You're requiring the market to give you more than it usually does, which by definition happens less frequently. Here's a framework that might help you understand this better. Imagine you're a fisherman. You can catch many small fish with a net, or you can try to spear one big fish. The net catches fish consistently because you're not being too selective. The spear requires perfect timing, perfect aim, and the big fish has to actually swim by. Both can feed you, but which one keeps you fed more reliably? Now, I'm not saying 3-to-1 or higher ratios never work. In certain market conditions, with certain strategies, with proper position sizing and risk management, they absolutely can work. The point is that they're not inherently superior to 1-to-1 ratios. In fact, for most traders, especially those still developing their skills, 1-to-1 ratios are often more profitable because they're more achievable and more forgiving. Consider the learning curve. When you're starting out, you need feedback. You need to see what works and what doesn't. With a 1-to-1 ratio and a higher win rate, you get more winners. More winners means more positive feedback. More positive feedback means better learning and stronger psychology. You build confidence. You build competence. With a 3-to-1 ratio and a low win rate, you're losing most of the time while you're learning. That's a brutal combination. There's also the practical matter of trade management. With a 1-to-1 ratio, your decision-making is simpler. You're either right or wrong relatively quickly. With a 3-to-1 ratio, you have to manage the position through more price action, more noise, more opportunities to make mistakes. You might need to trail stops, adjust targets, deal with partial profits. Every decision point is another chance to mess up. Let's talk numbers one more time to really hammer this home. If you trade with proper risk management, risking 1% of your account per trade, and you have a 1-to-1 ratio with 60% win rate, you're making 0.2% per trade on average. That's your expectancy. Take 100 trades and you're up 20%. Take 500 trades in a year and you've doubled your account. Boring, steady, reliable. Now imagine you've got that 3-to-1 ratio, but you can only hit 25% winners because the targets are so difficult. Your expectancy is now negative. You're making 0.75% on average per winner, but losing 1% on 75% of trades. You're slowly going broke while thinking you're being disciplined because you're following the rule about risk-reward ratios. The markets reward consistency, not heroics. They reward showing up every day and executing your edge without emotion. They punish trying to be perfect, trying to hit massive winners, trying to make up for losses with home run trades. The trader who makes a little bit every day will always beat the trader who's trying to make a lot on one trade. Here's my challenge to you. Stop worrying about risk-reward ratios and start obsessing about expectancy. Figure out your actual win rate with your actual strategy. Calculate your real expectancy. If it's positive, you have an edge. Scale it up, execute it consistently. If it's negative, fix your strategy before you risk another dollar. The ratio doesn't matter. The expectancy is everything. And if you're still not convinced, try this experiment. Paper trade both approaches for 3 months. Track every single trade. Calculate your real win rates and real expectancy for both the 1-to-1 and 3-to-1 setups. I promise you'll be shocked at how different the theory looks from the reality. Most traders discover their actual win rate with aggressive ratios is way lower than they expected. The bottom line is this: making money in the markets isn't about looking smart or following rules that sound good. It's about finding a mathematical edge and executing it without letting your ego, your emotions, or popular wisdom get in the way. A 1-to-1 risk-reward ratio with a solid win rate is a mathematical edge. It's not sexy. It won't impress anyone on social media. But it will make you money. And at the end of the day, that's the only scoreboard that matters.